While the S&P 500 is barely down 1% from its all-time high, many companies like Microsoft, Palantir, Netflix, and even Bitcoin is down 40% from its all-time high. So I'm seeing a massive, massive divergence that I really haven't seen before. And I have two amazing growth stocks that I want to talk about today. They're down a lot recently, and I believe both of them are presenting an opportunity for long-term investors. So I really hope you enjoy it as always. The first one is SoFi. I haven't talked about SoFi in a while. It's down 17% year to date. I think it's presenting a really good setup, in my opinion. SoFi's earnings report, which they just reported on Friday, it was an amazing report. They grew 38% revenues. Adjusted EBITDA margin has expanded to a record of 29%. And this is the second year of the company being profitable. And their net income margin right now is about 13%. This is really amazing for the company. They have been growing members at a 54% CAGR from 650,000 members to over 13.5 million members. And the adult population in the United States is about 220 million. So this is not even a 10% market share for SoFi. So you could really see the massive runways that we have over here. And many people believe they're late to SoFi, and I believe they're much earlier than they believe. Now, looking at the reason why the stock has gone down, there's a lot of reasons why, but mainly the market was down in general. But a lot of people are saying it's due to Chime, which is actually a competitor of them, but they used SoFi's business-to-business platform, and they pretty much moved on their own, and they lost them as a customer. Now, the guidance already includes the loss of Chime, so it wasn't a surprise, it wasn't anything. But the stock sold off 6.5% on earnings, and I found it very, very funny. The company continues to diversify away into fee-based revenues, and fee-based revenues is what's really expanding the company's net income margin. It's going to expand it much more over time, as right now they're implementing more of a Robinhood business model. Robinhood is not a bank. Robinhood partners with third-party banks, and whenever, let's say, you want to apply for a mortgage, for a home loan, Robinhood is not holding the loan on the balance sheet. Robinhood collects origination fee for referring you to the third-party customers. They're more of a middleman, and they're not taking the credit risk if you don't pay back your loan. SoFi is a bank, but they're starting to implement this same business model. And now if you apply for a personal loan on the SoFi platform, most of those loans, especially the risky loans, SoFi is not going to hold them on the balance sheet. They're not going to take the credit risk, and they don't care if you pay or if you don't pay. They're referring you to a third-party lender, and this third-party lender is the one that's taking the credit risk. And that's really improving the risk profile and the margin profile of the company in general. Now, looking at the valuation right now, it's trading at about 38 times earnings. It used to trade at 65 times earnings not long ago, and this is when I started trimming SoFi on YouTube. I did a video about it. Now trading at 38 times earnings. 38 times earnings might sound expensive if you just look at it, but it's not really expensive if the company's management team is guiding for a compounded annual growth rate for earnings per share of 38 to 42% between 2025 and 2028. So you're pretty much buying it for a one peg ratio or one price to earnings growth. And this is really, really cheap by any metrics for any growth company in general. But most importantly, this guidance doesn't assume any changes to the macroeconomic environment and no significant new businesses launches or acquisitions. Now, it doesn't include acquisitions, but the CEO spoke about the acquisition pipeline on the earnings call, and he said there's a lot of opportunities out there. I would say more than we've ever seen in our 8 years here at SoFi. So that does not include acquisitions. The company has a lot of cash on the balance sheet, and they can do many more acquisitions, and this revenue or earnings per share growth guidance will likely be conservative. Now, this is my valuation model on SoFi. I used 39 cents, and 2026 guidance is 60 cents. So this is what I put in my model, 39 cents, 60 cents. Then they guided for a 40% CAGR. So I took it from 55% growth to 40%, 38%. Then I gradually took it down to 30%, then 25%. The current PE is about 40 times, assuming a multiple contraction to 25 times, although I doubt it because the company will be much more profitable over the long term and should still command a higher multiple despite the company decelerating in earnings per share growth. But let's assume again the worst case scenario, multiple contraction from 40 times to 25 times earnings. In this case, I'm getting $47 per share or 116% on the upside or 16% annual return for buying a bank or an amazing company like SoFi at today's price. Now, I'm being honest with you guys, those estimates are conservative. The company is well known for sandbagging guidance. Everyone knows that. And if you look at the record, they beat the analyst estimates 8 quarters out of 8. So 8 out of 8, pretty much they beat them. They haven't missed a single quarter. They never disappoint. They always raise the estimates. So those estimates are conservative. But assuming that maybe SoFi keeps commanding a 40 PE multiple 5 years from now, if that does happen, then the total return would be about 245% or 28% annual return from today's price. If you're buying SoFi at $22, I see up to $75 per share on SoFi by 2030, which would really be an amazing return. So worst case, I'm saying 15-16% a year. Best case, up to 25-30% a year with an amazing management team. So I like the risk-reward setup on SoFi over here. I don't know if the stock's gonna go lower, but I really love it, and I own the stock, and I really want to hold it for the long term. And I'm very excited about the story and the CEO and everything that's happening. And they could potentially be included in the S&P this year in 2026. So that's another catalyst that could, help the stock price in the short term. Now, this is the second one, which is my most hated stock by far. I believe I'm the only one left that's holding it. That's what I feel sometimes. And this is Hims and Hers Health. A lot of people that I know have capitulated on the stock because it's been really painful to hold the stock. I've been holding it from $7 per share in 2023, and I've been through ups and downs. And this has been by far the longest one. It has not been the largest drawdown ever. Back in April, we had about a 63% drawdown from the peak. This is another 60%, but this one felt like much worse because it has lasted pretty much since September. It has been going down while all the growth stocks have been going up and the market was going up, and Hims keeps on going down every single day. And there's just really bad sentiment on this one. The company should trade at 5 and 6 times sales. Now it's trading at 2 times sales. I never imagined I would be able to look at Hims and see the stock trading at 2 times sales. This is really cheap for a company that's growing sales 49% and will likely continue to massively grow sales or revenues over the next 3 to 5 years. Now, there's one main reason why Hims has been going down, and I believe, and I still believe, that this is a misunderstanding from the market. I still believe the market is making a mistake, and investors are making a mistake by believing that Hims is just a GLP-1 story. And the GLP-1 story, or the weight loss story, has been wiped out because NVO has the oral pills, Lilly has the oral pills, and they cost like $160 a month. So if you can get them from NVO, why would you get the compounded semaglutide from Hims? It doesn't make any sense. And that's really waiting on the business model. And people believe that just because of that, Hims is dead. But people forget that Hims used to grow in revenues 93%, 82%, 80%, even 65% before they even got into weight loss, before they even got into GLP-1. Why? Because they are also into many other areas. Sexual health, guys. This is over a 250 million TAM in the United States, 160 million TAM in Europe, and 30 million in Canada. And they're just expanding in Europe and Canada. You really want me to believe that Hims cannot generate any revenue growth from sexual health? How about dermatology in terms of skincare, in terms of hair loss? Those are massive, massive TAMs. The company does not need to be a weight loss leader. They have so many different areas they can compete in. How about mental health? Mental health is huge, especially in the United States. Hormone health, longevity, and a lot of things within hers and menopause and things within women's health in general. So Hims doesn't really need GLP-1s. It doesn't need weight loss. But I believe, and this is my thesis, that Hims has been undergoing what I would call a transition period. The company is transitioning away from a GLP-1 company because GLP-1 have massively boosted revenues to trying to cross-sell more products and focus on different categories in general. And that has been waiting on the revenue growth. The first quarter was amazing. Second quarter wasn't as much. Third quarter has picked up a little bit better. And the company, again, is diversifying their revenue base. And I believe this is a transition period. The company has so many catalysts. They're expanding in Canada, expanding in Europe. We should see all of those things in 2026. So that's why I've been telling investors, give him his 1 to 3 quarters and see what the management does. They have $1 billion in cash. They have everything. So just give them 3 quarters. The CEO has an amazing track record. He built this company out of nothing. He grew members to like 2 million members in total. So you could see the members from like 290,000 to 2.4 million. Do I really want to bet against him right now? I don't know. So that's why I've been telling members, I've been telling people in general, just give it a few quarters. And there's a lot of things that are happening within HIMS. The company has launched its Super Bowl ad, and it's a really interesting one. It says rich people live longer, and it's mainly about that rich people have their dedicated doctors and dedicated systems. They have custom peptides, and they have a lot of things custom made for them. And HIMS is trying to do the same thing, but for the overall populations that cannot afford all the private related stuff. Just like Robinhood is bringing private banking to the population and everyone else, HIMS is trying to bring this customized healthcare to everyone through custom peptide, which hasn't started yet, and also mainly labs and just anything pretty much other than just weight loss. So they're really trying to promote those other products. And I think that's going to do wonders. Now, there's something that people forget is that HIMS is the only telehealth company that owns a peptide facility. It's the only one. Ro doesn't own a peptide facility. A lot of those companies do not own a peptide facility. A lot of people are saying peptide is the future. HIMS will likely be a leader in peptide that's not being priced in the company. There's a lot of research that's saying that in their 503B facility, which is mainly the peptide facility, HIMS is trying to research up to 3 new products, 3 new different drugs. And that's a major milestone, a major step forward for HIMS. And again, this is a license and this is all the information. And it's not being priced in the stock. It's still being priced as a GLP-1 company. Nothing about peptide, nothing around anything that could potentially come, even though the company is hiring a lot of people to help the safe launch of new treatments, new products. So they're working, and people just keep looking at the stock price and then get upset, while you have a founder CEO that has proven himself to grow this company really well, and he's not growing anywhere. And then you combine all of that with the HIMS labs, which I believe is going to be a game changer for the company, because it's going to allow with the company to have a sticky, recurring revenue-based business model where people are paying for the subscription to track their health, and anything that's missing in cholesterol or whatever is missing in their body, whatever they have to improve, they will be able to buy those products through the HIMS and HERS ecosystem, and they're going to have to keep tracking their health. They don't just track it one time and that's it. This is on a consistent basis, which is going to make the HIMS subscription more sticky. And I think it should boost the multiple over the long term, as is there going to be much more predictability in the revenues. And again, the market doesn't care about any of that stuff. And it took the company down to 2 times sales. Now, if you look at the company's guidance, and they have a great record of beating their estimates, and on the latest call, they said they are very confident in seeing at least $6.5 billion in revenue by 2030. Now, the current market cap, guys, is $6.8 billion. So we're pretty much paying 1 time potential 2030 revenues. Based on all the catalysts I just showed you with peptide and with the labs business, with them expanding in Europe, expanding in Canada, diversifying away from just being a weight loss company, launching the Super Bowl ads, mainly around custom peptides and around the labs in general, there's a lot of potential with the stock. And 1 time 2030 guidance, or even 2 times current sales or forward sales, I think it's extremely cheap for the company. And I still believe the market is making a major, major mistake by doubting a founder CEO. He has $1 billion in cash. and he knows the company very well. He knows the industry very well. And he even said in one of his previous videos that he believes GLP-1s, you'll be able to get them for $20 or $30 over the next 3 to 4 years. And everyone is surprised that Hims is losing market share and weight loss. But the CEO already knows that. He's not stupid. And that's why he's been diversifying away. So I think this is a transition period. It's going to take 2 to 3 quarters. And after that, I think it will be much, much better. And that's my opinion on Hims and SoFi. I think SoFi is much safer. Of course, it's a bank. Hims is a little bit riskier, but I think it's much more rewarding. Not financial advice. Hope you enjoyed it. If you did enjoy it, please press the like button and maybe consider subscribing. So I'll talk to you in another video.